Hello and welcome to the HOA Show, where we discuss the news, problems, trends, and critical issues relating to life in a homeowner association. Join us every episode, and together we'll explore how to survive and thrive in the dizzying world of HOAs.
Hello and welcome to the HOA Show. My name is Ryan Gazelle and I'm joined now by Tim Klein and Kim Randall. So Tim, you've been in the insurance industry for how long now?
38 years.
And you've focused your practice exclusively on common interest developments during that time, right?
Right. You know, we only write condominium associations, co-ops, planned unit developments. That's our niche.
Perfect. And our other guest is Kim Randall, the Executive Vice President and Property Director for Worldwide Facilities. Kim, you've been in the insurance industry since the 70s. I know you've worked at a number of companies, but you've been with Worldwide since
2000, be almost 20 years.
And Worldwide Facilities is a wholesale company. Can you explain what that is to our listeners?
Basically, a wholesale company is an intermediary between the retailers or your insurance agent and the markets that sell earthquake insurance. The standard markets that your retailers have access to normally don't like to write earthquake, so you come into an excess and surplus or specialty market, and that's where we can place either things with earthquake, or if there's certain things that carriers are getting off, like wildfire exposures or accounts that have a lot of water damage losses, claim activity or potential for large losses, that usually ends up in the intermediary market.
And we'd call that the excess and surplus lines market, or E&S for short, which I'm sure we'll refer to during this program. And a condo association or a client couldn't go directly to you, right? They'd need to go to...
That is correct. They would need to go to somebody like Klein Insurance Agency, and they would then come to me. I don't normally work directly with the insureds unless Tim Klein asked me to attend a meeting with them.
Mm-hmm. To answer those tough questions.
Yeah.
And Kim, you were just recently named by Insurance Business America as one of 2019's elite women in insurance. What exactly is Insurance Business America?
It's an insurance magazine that comes out on a monthly basis, and they normally talk about what's going on in the excess and surplus arena, people that are important into the excess and surplus arena, and what goes on in Lloyd's of London and how that affects the United States domestic market.
Can I just say something? I mean, There's not a person that I've met in this industry that has more experience, more knowledge about the marketplace and the product, and more tenacity than Kim Randall. I mean, she is absolutely the go-to person on a hard-to-place account.
Well, thank you, Tim. Thank you.
Well, Kim, thank you for your eliteness. So now on to our topic, wildfires. Now, with all the experience that both of you have, I wanted to pick your brains about what we're currently seeing in the property insurance market, specifically regarding wildfire exposures. According to the California Department of Insurance, the insured wildfire losses from just November of 2018 was more than $12 billion. That's just November in 1 year, 1 month. And 2018 wasn't just a one-off. According to the National Interagency Fire Center, in 2015, there were more than 10 million acres burned in the U.S. 2016, that dropped down to about 6 million, but then 2017 was back up to 10 million, and 2018 saw about 9 million acres burned. Tim, are you seeing a lot of your clients being non-renewed?
Yeah, we're seeing a fair number of them. And it's an interesting thing. You know, we used to be concerned about whether or not they had 300 feet of brush cleared back from their risk. Now, because we're recognizing that wildfires are a product of the Santa Ana wind conditions that we have in California, those embers can go a half mile or farther.
Right, a mile, I think, was what we saw in the Oak Park in the Woolsey fire last year.
So all of a sudden, the projections, the computer modeling software that carriers use, are now showing risks to be in a brush area that we'd never consider to have that kind of exposure. You know, in a typical insurance setting, if buildings are 60 feet apart, we consider them to be separate fire divisions, meaning there's not really a potential of the risk spreading from one account to the other, one building to the other. Now that's just completely a different circumstance altogether, and accounts that we never ever dreamed would have a brush exposure are either being non-renewed for wildfire or the rates are increasing dramatically.
Kim, are you seeing an influx of applications?
We are seeing a lot come in with the wildfire exposures. And as Tim said, it's a broader brush than it used to be. No pun intended. But it's dipping into places where you wouldn't think they were a brush exposure. So we're seeing a lot more of that coming into the E&S marketplace. And what's having to happen is we have to get more carriers involved. When it's been with a standard preferred market, it usually has somebody that's doing all your property and your liability in a package, and maybe even your D&O. But now with these things coming out with the wildfire, we're finding that we're having to get 3 to 4 to 5 carriers involved in order to be able to write it, because they feel the exposure is so great that nobody wants to put up 20 million or 30 million. They want to put up maybe 5 million or 10 million. So it becomes a much more expensive process just because you've got more people looking at it and the exposure is there.
So in essence, it's becoming a certainty that we are going to have wildfires every year.
Yes.
The question is just,
where's it going to happen? Yeah.
What are the odds that this one's going to go?
Right.
It's a perfect storm in Southern California, Brian. You've got a circumstance where you've got manzanita and chaparral, 2 brush plants that have a high oil content. You've got Santa Ana wind conditions, and you've got an environment where we're building homes farther and farther and farther into these brush areas. So now we've really got ourselves set up, whether you call it global warming or climate change, we've got a circumstance set up where there is really a huge exposure for loss, and the carriers now are recognizing it. And the more accounts that they place, the less capital they have to place additional accounts. And I think we're just going to see that scale of premiums continue to rise.
Now, what about those folks that say, well, everything burned last year, there's nothing left?
There's a lot of property exposed to loss, and there's still plenty available to burn.
And I like to point out that all that rain we had, it's lovely, and it's just building new brush for us to burn next year.
It is. If we could talk, there's really 2 different types of accounts in terms of our common interest development industry that are being exposed. There is the condominium association that Kim made reference to, where you have both the units and the common areas exposed. And then we have planned developments where the association doesn't have an insurable interest in the dwellings, but maybe has a lot of green belts and common area amenities that are exposed to loss. And if those fires communicate from those green belts onto the homes, then I think there's a huge liability exposure for the association. So we're seeing, even in those planned developments, where we used to think it was not a big deal exposure-wise, now really being concerned about wildfires.
Yeah, and you're talking about with a planned development, sometimes the premiums were down around $3,000 to $5,000, and now they're looking at $50,000 to $60,000 just for the property coverage.
Right, just for the property coverage.
Because the risk is there. Even if you've got $100,000 in trees and shrubs, that's probably going to go up. And then the cost of irrigation systems, you don't think that the irrigation can melt, but that's going to go.
Yeah,
right?
The heat just absolutely melts them to pieces.
Kim, what do you see for the future? I mean, is this going to be the new norm, do you think?
Well, insurance is always cyclical. And so this too shall pass, I expect. But I think we are going to see it for the foreseeable future, because California is going to continue to burn. And Colorado and some of those places where there are a lot of homeowners associations and PUDs. But I think that there's ways for the insureds to ameliorate that. And I think that Tim was going to talk about that a little bit more. But the more information someone has, the more information your insurance agent has that we can pass on that's good information to the underwriters, the better opportunity you're going to have to get insurance and to keep a good rate on it. But yeah, I think over the next few years, because there's been a lot of losses in other parts of the world and other parts of the country, and the carriers are losing money, and they can't keep an operation if they're going to continue to lose money. So they need to.
So you're saying that the insurance industry as a whole has been losing money?
Correct.
Every year?
Yes. And what we are also looking at is, I looked at some of the accounts that Tim and I have done, and we've written them for the last 15 years. And every year the premium went down, the rate went down. And so there's only so long that's sustainable. And then on top of that, you add losses, and they're not making enough money to pay. I saw an article the other day that said for every dollar that the personal lines companies took in, they paid out $1.70 over the last 2 years.
Just for wildfires.
Just for wildfires.
Wow.
But the interesting thing, I think, and it's difficult for our clients to understand, is that the wildfire exposure here impacts the hurricane rates on the East Coast. The hurricane activity impacts the earthquake rates on the West Coast. we're all kind of tied together at the hip by virtue of the reinsurance marketplace and the fact that that's really a global exchange. And when there are global events, it's going to impact us because there's less capital available to write these exposures. And those people who have capital want to get as much money as they can for every dollar they're placed.
That's a great point. Kim, can you talk a little bit and explain what reinsurance is?
Well, reinsurance is basically insuring the insurance companies. None of the insurance companies have the capacity to take all of this risk on their own. So they do what they call cede, or they give away some of their premium in order to get protection of insurance limits from the reinsurers.
So that'd be, as an example, if you've got a risk that's $10 million in the hills, they might take on how much of that?
Well, especially when you're talking about a wildfire exposure or something like that, the insurance carrier might only take the first 500,000 or million, and then the rest of it would be reinsured through various programs that they would have. So, but you would the client would never see that because it would come out as a traveler's policy for $10 million. You would never know it's behind the scenes. Mm-hmm. But because everybody has reinsurance and all this reinsurance is tied back in, that it becomes incestuous almost, that they all end up being on the same losses, and that's why it's driving these numbers up.
So according to VeriRisk, there are more than 2 million homes in California that are in an area of high or extreme risk to wildfire, by far more than any other state. Obviously, it's beautiful. Texas was a distant second with 715,000. And we're still building. It seems like all of the new construction that we're seeing are mostly up in the hills because it's desirable. You've got a beautiful view. But what can these associations or these buildings, what can they do to protect themselves?
The Uniform Building Code now requires certain types of fire-resistive structures anyway. I mean, we got rid of wood-shake roofs in California over the last 10 to 15 years, fortunately. But there's been really a lot more emphasis on fire-resistive construction. Stucco and rock exteriors that are less prone to fire damage. And there's something now called an automatic soffit closing system, which will allow the soffits, which are effectively venting systems for the attics of dwellings, to be closed automatically to prohibit those embers from getting up into the attics and causing home fires on homes that are unattended and unprotected, which is really a good result. So I think we're seeing more technology around those type of issues. I think we want to see more fire-resistant plant material planted nearer the dwelling, and probably the setbacks will be greater than 300 feet anymore, in order to prevent these huge kind of fires that are just raging across the country.
And even then, if you've cleared the brush to 300 feet, as you suggested earlier, the embers can float up to a mile in the air. So if you don't have those sealed soffits, the vents, it can float right up in there.
Some of the other things they can do, too, is consider if they don't have tile roofs now and they're thinking about replacing the roofs, to really consider replacing them with tile roofs. You can also enclose the eaves, because that's a lot of times where the fire starts, like going in through those openings, but it also comes up under the eaves and then starts in the bottom of the wood roofs there. And so they go up and you can enclose those. Also, I think about with the cost that's going on, that's driving up, that looking into putting sprinklers on the roofs. I think in a lot of cases with the new construction, some of them are sprinkling the roofs.
Outside the roof?
Uh-huh. And seeing how much that would cost and the installation, because if you think about amortizing that over the years and the savings that you could potentially get on your insurance because you have that, plus your home's not going to go up in flames, more than likely.
So you think that underwriters would be more willing to entertain a risk? They'll listen to that kind of an argument?
In fact, I got involved in an account a few weeks back where somebody was working it, but they didn't have a lot of the facts that I discovered. They didn't ask about the roofs. They didn't ask about the clearance. They didn't ask about the eaves. When we went on Google Maps and looked at it, we saw that they had the enclosed eaves, that they had tile roofs. We found out the clearance. We could tell that the fire departments were only 3 or 4 miles away. All of that. And then I went back to some of the carriers that had declined the account, and they were willing to look at it because they had this additional information. So the additional information made them, instead of staying away from the table, made them come to the table.
Are there any kind of creative solutions that you've seen in order to get a carrier to write this risk beyond just the protections that have been put in place? Like you as a broker, How do you get creative?
With some of that stuff, it's dealing with the deductibles. And I think we've talked about that, where instead of having what we call a flat dollar deductible, $5,000 or something to that effect, is they put a percentage deductible on it, as if they would in an earthquake. It's a catastrophic exposure. So what we're starting to see now is carriers putting a 5% deductible on, and that would be 5% of the replacement cost of the buildings that were involved in the loss, so that everybody has some play in the game. So we're seeing that. We're seeing where maybe we have to split this up in other ways on the accounts. Maybe they don't even buy full limits on it if it gets too costly. I think the thing is to give the insured as many options as they can, and then they have to decide where their pain point is.
And then this really puts a lot more emphasis on making sure every owner in that project has purchased loss assessment coverage. What's unusual, and particularly in a single-family home facility, like a planned development, oftentimes the agent or broker writing the account doesn't even realize that the home is in a planned development and subject potentially to a special assessment. A special assessment on some of these cases, but we've got a 5% deductible, could be quite large. So individual owners should be maintaining a loss assessment limit of $50,000 or higher on their standard policy, not to mention the earthquake.
And if you live in a condo, then obviously that's all the more important.
Right. Mm-hmm. Yeah, definitely.
Those deductibles could get pretty darn high. It's
just the circumstance. You live in a 100-unit association, you have 1/100th of everything that goes right. But in this event, you've got 1/100th of everything that goes wrong, and it's going to come to you as a special assessment. And unless you're prepared for that financially, and by buying loss assessment coverage, which is the only way to address this fire exposure, it needs to be purchased, and owners need to have it in their back pocket before the event occurs.
So, Kim, it feels like we're going into a hard market. That's what everybody's saying. We're going into a hard market. We were in a soft market. What does that mean? Can you explain that briefly?
Basically, a hard market is when rates are going up and accounts that have had challenges like wildfire, a lot of large losses, either fire or water damage, and the standard carriers maybe aren't as forgiving as they used to be, because all of a sudden these losses are starting to ratchet up and they see that they're losing money. So hard market is when the rates are going up and there's more accounts coming into the E&S marketplace because the standard markets are getting off of them. Soft market is just the opposite. The business flows back from the E&S marketplace to the standard carriers after a certain period of time. Maybe their losses have been cleaned up. Maybe they've made a lot of improvements on their property, so the wildfire is not as much of an exposure as it used to be.
Sort of like a seller's market versus a buyer's market.
Exactly.
And if I could just interject here, the interesting thing about the condominium marketplace, I mentioned that first account I wrote in 1981 is now 38 years old. So it's got 38-year-old pipes. It's got 38-year-old siding. The infrastructure in that, the electrical wiring and so forth, at some point in time, is going to either fail or have to be replaced. And so we're seeing a multitude of water damage losses in some of these accounts because there's been deferred maintenance, because of pipes and risers have not been replaced or restored. So we're going to see more and more of that product go into the excess and surplus lines market, whether it's standard E&S or kind of E&S light, but there's going to be a home for those outside the standard market because it's just inevitable that these accounts are going to get older. And this reserving for those needed repairs hasn't been done.
Any closing thoughts on wildfires and the insurance market, Kim?
Well, I think, we're going to ride out this next year and see. I mean, the last couple of years have been a shock. Like Paradise, a whole town would burn down, and the houses in Santa Rosa that we thought were suburbs burned. And so if we see something like that again this year, it's going to get even more difficult to place this business and more costly. If we can get through the wildfire season this year with little commercial or personal property being damaged, then things will level out a little bit. I think we're still going to find that standard carriers be wary of the wildfire exposure. But it depends on how that goes. And it also depends on whether the ground shakes in a more populated area than Ridgecrest, or whether a hurricane blows through Miami. So we've got a hurricane season to get through and every day's earthquake season.
And although, property insurance is required by lenders, it's not a right. So these carriers are in it to make a profit.
Correct.
And so I know a lot of our clients are feeling, when they get these non-renewal notices, like they're being dumped by this carrier they've been paying premium to for the last 10 years without a claim. But those carriers have to look at it from a profit loss standpoint, right?
That's correct.
I mean, if your risk isn't profitable and the game has changed, we're not going to offer you that.
Well,
coverage.
and sometimes the carriers will decide to get off a class of business just because as an overall class of business, it's lost money for them. And they just don't have the wherewithal to pick and choose. It's kind of like all or nothing. So they kind of sometimes overreact and say, oh, this wildfire, we got to get off of everything that's within 5 miles of brush or something. And so out goes the baby with the bathwater. And then they start looking at it again in a few years going, and then they start creeping back in again. It's cyclical. It happens all the time.
Recalibrating.
Yes.
Tim, any other thoughts?
I just wanted to comment a little bit about the excess and surplus lines marketplace because I get the impression from my clients that when we place an account with one of these carriers that they've never heard of before, that we're kind of going into the wild, wild west, that somehow all the rules are out of the marketplace. This is an unregulated carrier that's domiciled somewhere outside the United States. In most cases, that's not true.
Correct. Most of the carriers, with the exception of Lloyd's of London, of course, most of them are domestic. And although they're maybe different and you haven't heard of them before, there are rating systems. There's a best rating guide that will rate the carriers from an A+15 down to somebody you wouldn't want to write with. So and this is an outside agency that is not controlled by the insurance companies. So if you're not familiar with the carrier, you just ask your retail agent, what's their best rating? Because if you have something that's an A+15 carrier, even if you've never heard of them, you're going to be okay. It's a good carrier. Anything that's rated A-8 and above is going to be a solid carrier for you. A-7, A-8 in that range and up. You would not want to write any of this stuff most of the time, probably with a B-rated carrier, because if they get hit with a lot of losses, they may not be able to pay all the losses.
And one of the key components to that rating system is they look at the exposure that carrier has in a particular area as well as in a particular type of coverage, right?
Correct.
So
and they look at their financials too to make sure that they're underwriting things properly and that they're making enough money to stay in business.
And they want to make sure you don't have all your eggs in one basket. If all you write is earthquake insurance on the San Andreas Fault, that's not a good rating.
That's right.
I think there's one other, I know we're getting close to wrapping up. I think it's one of the things that's interesting to me is that in the Northridge earthquake, Kim and I went through, my feeling is that the carrier just took a number out of a hat and said, this is what we're going to charge for the first 5 million or first 10 million. It just didn't seem to me that the underwriting was very sophisticated. Now with earthquake modeling, maybe you could help explain this, but my understanding is that the carrier knows how much exposure they have on neighboring fault lines. They know how often that fault line has produced earthquakes. They were predicting what the potential is of there being an earthquake in the next year. And then they also look at their exposure to see if they've got enough money to be able to pay the claim. It's a much more sophisticated model than it was in Northridge.
That's correct. And it even goes as specific as the soil underneath buildings and areas that they can tell if there's going to be liquefaction exposure. And it does keep track of their exposure on any given fault. And so if it gets too much, they're not going to want to write it because they are afraid of being able to pay all the losses. So they're self-regulating to a certain extent too. Nobody wants to be in a position where they're not going to be able to pay their claims. So that's why they pay strict attention to how much they've got exposed in any one area. But some of it's a guess too. I mean, nobody knew the Northridge Fault was there until it went in '94.
I know that's an interesting scenario, and I find some frustration with carriers, and I'm naming one in particular, Golden Bear, who will shut down in certain zip codes, and it seems very arbitrary, of course, when we have an account we want to place in that zip code. But we also have to have a lot of appreciation for them that they're really willing to be self-regulating to that degree that they get to a point where they know they shouldn't be taking more on, and they just don't take another account there.
That's right. There's always you can always find somebody else that will. It's just you're going to pay the price or not. But yeah, everybody's self-regulating. There may be a little bit more noticeable because they put a hard stop on it. Some of the other carriers will still quote it, but they'll quote it with a very high premium. And so in hopes that either the account goes away or if they write it, they're okay because they'll get a lot of money for it.
Right.
And that same principle of self-regulation is why, going back to the wildfires, we're having to place in the E&S market, $1 million here, $5 million here, another $1 million here, varying the layers and bringing more carriers on, right?
That's correct. They're trying to keep from having an $80 million loss in one location.
Which they probably saw in Paradise.
They did.
And in Santa Rosa.
Yeah, we have one carrier that has become very difficult to deal with. It used to write willingly in certain places, but they ended up having an unexpected loss of about $80 million in Paradise. And they were all medical office buildings. They never expected to have that kind of loss, and it wiped them all out, and they had an $80 million unexpected loss. Nobody likes that.
No, the shareholders not too fond of that.
I just wanted to comment a little bit about common interest developments. We just take one more second to talk about the fact that in an 100-unit association, there are potentially 100 owners. Maybe 10% of them are landlords that rent their units out, but the remaining 90 are homeowners. When there's a fire, the master policy does not pick up their loss of use. That is to say, if they have to live elsewhere because of this firestorm, it can get expensive. And as there's more demand for that type of housing, it'll even get more expensive. And so owners, in addition to loss assessment coverage, which we talked about earlier, needs to make sure that they get loss of use, or in the case of a landlord, loss of rents coverage, to protect them against exposure, because it can take 12, 15, 18 months to get the plans, get permits, get 3 bids, and get the project rebuilt.
And the master policy is not going to pay them to do that.
Because the owner only owns the airspace inside that unit. They don't have an insurable interest in the structural components. So the only one that can insure the loss of that airspace, the loss of use, is the individual unit owner.
And one caveat on that, just adding on, is the cost of eating out is much more expensive than the cost of cooking in your kitchen every night. So make sure you've got enough limits.
Exactly.
So Tim, how can folks get a hold of you if they'd have more questions?
We have a robust website at www.kleinagency.com, and that's Klein with a C, C-L-I-N-E, agency.com.
All right. Kim, you don't want to talk to anybody. You want them to go through Tim.
They can call Tim, and then he can tell me if I can talk to them.
Sounds good. Well, that's our show for today. Thanks, everybody, for listening. I'd like to thank Kim Randall and Tim Klein for their time and expertise. As we end our episode, we'd like to remind our listeners that if you have any comments, questions, or suggestions for topics that you'd like to learn more about, you can email us at feedback@hoashow.org. feedback@hoashow.org. Join us next time on The HOA Show.
To share or subscribe to The HOA Show, visit us at hoashow.org. There, you'll be able to listen to other episodes, find helpful resources relating to HOAs, provide feedback, submit questions, and check out other great stuff. The HOA Show podcast has been made possible by the contributions of Klein Agency Insurance Brokers, leaders in the community association industry. The views and opinions expressed by the podcast, its presenters and guests, do not constitute legal advice. For more information on how the topics in discussion apply to you, please consult with your own legal counsel.